Imagine waking up on a Friday, your business thriving, your bank accounts full. By Monday, it's all gone. This was the terrifying reality for countless startups and investors when Silicon Valley Bank, the 16th largest bank in the US, collapsed. In just 48 hours, an astonishing $42 billion vanished, leaving a trail of panic and uncertainty across the tech world. This is the story of how a pillar of the startup ecosystem crumbled with unprecedented speed. Founded in 1983, Silicon Valley Bank was more than just a financial institution. It was the lifeblood of the tech industry. It specialized in serving startups, venture capitalists, and tech companies, becoming deeply embedded in the ecosystem. By 2022, SVB banked nearly half of all venture-backed tech companies in the US, boasting major clients like Roku and Roblox. Its deposits exploded from $60 billion in 2019 to an astounding $189 billion by 2021. This massive influx of cash, fueled by a low interest rate environment, presented SVB with a critical decision: what to do with all that money. Their choice, seemingly safe at the time, would prove to be their undoing. SVB invested a staggering $120 billion into long-term U.S. Treasuries and mortgage-backed securities. These were considered safe assets, purchased when interest rates were near historic lows, yielding around 2%. However, the economic landscape shifted dramatically. To combat soaring inflation, the Federal Reserve began aggressively hiking interest rates, pushing them to over 5%. This move had a devastating impact on SVB's bond portfolio. As interest rates rose, the market value of SVB's existing low-yield bonds plummeted. What was once a safe bet turned into a ticking time bomb, accumulating $17 billion in unrealized losses. The death spiral began as the venture capital market dried up, forcing many startups to withdraw their cash from SVB to cover operational expenses. The bank, facing liquidity issues, was forced to sell its depreciated bonds. In a desperate attempt to raise capital, SVB sold $21 billion worth of its bond portfolio, incurring a staggering $1.8 billion loss. This move, intended to stabilize the bank, instead ignited a firestorm of panic. On March 8th, SVB announced its intention to raise $2.25 billion in capital. This news, coupled with the bond sale loss, spread like wildfire through the tightly knit tech community, amplified by social media. Venture capitalists, fearing the worst, advised their portfolio companies to withdraw funds immediately. This collective action triggered a catastrophic bank run, unlike anything seen in the digital age. On Thursday, March 9th, a staggering $42 billion was withdrawn from SVB in a single day. The bank, unable to meet the demand, was effectively insolvent. By Friday, March 10th, California regulators intervened, shutting down Silicon Valley Bank and placing it under the receivership of the FDIC. The collapse was complete, marking the second largest bank failure in U.S. history. The rapid downfall of SVB sent shockwaves across the financial world, sparking fears of contagion. Other regional banks, like Signature Bank and First Republic, also faced immense pressure. To prevent a wider crisis, the U.S. government took unprecedented action, guaranteeing all deposits at SVB, even those exceeding the standard $250,000 insurance limit. This move aimed to restore confidence and stabilize the system. The SVB collapse offered crucial lessons. Firstly, even seemingly safe investments can become risky when interest rates fluctuate dramatically. Diversification is not just a buzzword, it's a necessity. Secondly, the speed of digital bank runs, fueled by social media, poses a new challenge to financial stability. Trust, once built over decades, can erode in mere hours. Finally, the importance of robust risk management and effective regulatory oversight cannot be overstated. SVB's failure highlighted gaps that allowed a bank to grow too fast without adequate safeguards. The Silicon Valley Bank collapse serves as a powerful reminder of the fragility of financial systems and the lightning speed at which trust can be lost in our interconnected world. A dramatic 48 hours that reshaped banking.